Evening, everybody. Thank you for joining me this evening. I know it's a little bit late in the day. So firstly, I just wanted to say congratulations to all of you because HEC is an incredible school and you're all incredibly privileged and lucky. I know you've all worked incredibly hard to be here. And one of the things that I wish that I'd done in university a little bit more of was attend more events and been involved with more sort of speaker series. And I think that you guys get the opportunity to meet some pretty incredible people that will come and visit you at this university and this campus on these courses. So I definitely encourage you to continue joining and embracing that part of being on campus here at HEC. So the title of my speech today is probably a little bit unusual. It's called How Not to Create a Sustainable Investment Strategy. And the reason for this will come a little bit more clear as we go through the presentation. So essentially what I'm using here is the mental model of inversion. So what is inversion? Well, inversion is a Stoic philosophy, which was explored by the Roman Emperor Marcus Aurelius. And he was a general right on the battlefield. So in his book, which is called Meditations, he wrote, instead of thinking about how to win on the battlefield, one should consider the opposite, how to avoid losing. So you can see two people on the screen here. Just a show of hands, who knows who the gentleman is with the blue tie? This is pretty much everyone. So Warren Buffett, the world's best or most successful investor. And then on the left-hand side with the red tie, there's a clue on the slide, but don't look too closely. I guess we've got one or two hands. So this is Charlie Munger. Charlie Munger was Warren Buffett's right-hand man for almost 60 years. And Charlie Munger, he talked about inversion. And here on the right-hand side, he said, invert, always invert. Turn a situation or problem upside down, look at it backwards. What happens if all of our plans go wrong? Instead of looking for success, make a list of how to fail instead. And he gives some examples through sloth, envy, resentment, self-pity, entitlement, all the mental habits of self-defeat. Because if we avoid these things, then we're guaranteed to succeed. And that's the mental model of inversion that I'm going to be using here today. So we're going to be identifying all the things that we shouldn't do. And therefore, we will know exactly what we should do to succeed. So I'll give you a bit of background about myself. My name is Ardal Loh-Gronager, and I'm the managing partner of a hedge fund called Loh-Gronager Partners. So I'm responsible for all the investment decisions, and I run what's known as our global fund. I'm also the author of a book called The Perceptive Investor, of which I've got a copy here. So I'm going to plug my book slightly now. I'm going to give a signed copy to whoever asks me the best question during the Q&A. So no pressure in terms of questions. I'm half Danish, but born in the UK, and I was educated in Europe, Asia, and Australia. Aussi, je parle un peu de français parce que j'habite en Suisse quand j'ai fait mon année sabbatique. Mais ça, c'est tout ce que ma présentation que je dis en français aujourd'hui parce que nous avons une audience qui sont internationale. After that, I went and studied accounting and finance at Durham University in the UK. I have over 10 years experience in financial services on both the buy side and the sell side. I started with internships in sales and trading at Goldman Sachs and Swiss Re Asset Management, and then moved to be an interest rates trader at Morgan Stanley. So that's the macroeconomic side of investing. So we were analyzing global capital trends and macroeconomic flows and their impact on interest rates. And from there, I moved to be a credit trader at Credit Suisse. So that's much more focused on the microeconomic side of the business. So looking at income statements, cash flow statements, and balance sheets, and working out where within the capital structure of a bank we should be investing our own money and also the capital of our clients. And from there, I moved to be the chief investment officer for a UK-based family office. And that's where we came up with the investment philosophy that we run at my hedge fund, which is taking inspiration also from Warren Buffett. So my fund is called Loh-Gronager Partners, and I said there that we're based on the principles of the original Buffett partnerships, which were established by Warren Buffett in the 1950s. So one of the less well-known facts about Warren Buffett is before he started Berkshire Hathaway and ran that, which we all know is one of the 10 largest businesses in the world, he actually ran his own hedge funds. And that's where we take our inspiration from. So we're concentrated long-term value investors, and we have a diversified portfolio of equities all around the world. And they have several things in common. They have strong growth potential, widening economic moats, and they're run by high integrity management who think like we do as real business owners. I then often get asked, what separates your fund, Ardal, from everybody else? And for that, I often think a picture is worth 1,000 words. So what you can see here is a painting by a Belgian artist called René Magritte. And it's called La Clairvoyance, but in English we translate it roughly to perception. And what you can see there is the artist is pictured seated and he's looking at a stationary egg. Yet on the canvas, he's painting a fully grown bird in flight. And that is the skill of perception, being able to look at something today and projecting forward something completely different in the future. And that's what I would say successful investing is. I think it makes some sense just to explain a little bit more about the hedge fund industry more generally and what it looks like. So the term hedge fund actually came from the word hedge fund, which was pioneered by a gentleman called Alfred Winslow Jones back in 1949. And essentially the strategy that he has was that he bought some businesses that he thought were going to go up in value, and then he sold some businesses that he thought would go down in value, and therefore he had what he determined was a hedged fund. Now today there's an enormous plethora of different strategies, but ultimately the diagram at the bottom shows you what typically every hedge fund actually looks like. At one end you have all of the investors, and they pool their capital, i.e. their money, underneath a fund manager such as myself, and that fund manager has a specific investment strategy, and they take that cash and they invest it into a portfolio of assets to generate a specific rate of return that the investors would find attractive. So I mentioned there that the term hedge fund has come to encompass an enormous array of strategies. So in the pie chart here, you can see all the different types of strategies that we have. So everything from merger arbitrage to macro investing, and then to what we do at my fund, which is equity long only. The hedge fund industry more generally, there's about 10,000 hedge funds in the world at any one time, and they manage about $4 trillion of assets. So it's a relatively large industry in the financial space. So how then not to create a sustainable investment strategy? I think to make sure that our strategy is as unsustainable as possible, you need to make sure that your investment manager is both not a good investor and also not a good business person. Because there are two aspects to any investment business. One is the business side, and the other is the investment side, which we're going to be focusing on today. So I'd say you need to make sure that you don't have a passion for business. You're always thinking small. You don't enjoy taking calculated risks and starting and running a business. You want to make sure that your investment strategy is undifferentiated, right? It's the same as everybody else. And then I would say you don't want to be values focused. You don't want to be sustainability minded, and you don't want to be long-term orientated. And then when you do find some investors to give you their money, you want to make sure that those investors don't understand your strategy well, and therefore they're very short-term orientated. I think we can come up with 5 rules for how not to create a sustainable investment strategy that I'll run through today. And the first is to not be a values-based investor. Partnership. Don't have a partnership mentality in everything you do, such as trying to foster a collaborative environment centered around intellectual curiosity for you and your team. Focus. Don't believe that through dedication and passion that consistent success can be achieved. Excellence. Don't aspire to excellence in everything that you do. Reputation. Don't live by Warren Buffett's mantra that reputations take a lifetime to earn and only moments to lose. So be very short-sighted. Honesty. Don't make intellectual honesty a key part of your business philosophy and your investment strategy. And finally, integrity. Don't hold yourself to the highest possible standards, both personally and professionally. Always under-promise and under-deliver. And I think that way you're bound to make sure your strategy is not sustainable. Number 2, don't be a value investor. So what is value investing? Well, traditional value investing was practiced by Ben Graham, and he essentially was the one who was the first employer of Warren Buffett. And he essentially looked to find businesses that were trading below their liquidation value. And then you have traditional growth investing, and that was pioneered by Phil Fisher. And he emphasized the fact that you should buy a portfolio of businesses that will always grow. And essentially, if you combine those two together, you have what I call modern value investing, and that's sort of practiced by value investors such as myself and Warren Buffett today, where we say you should primarily purchase great companies at fair prices, and where feasible, purchase the entire business. You should run a concentrated portfolio operating in a diverse range of sectors and looking to hold them very long term. And then you should remain open to special situations and strategic investments. So value investing is one of the only strategies long term that we've seen over time can produce outstanding returns in the market, and you can actually beat the market over the long term. So if we don't adopt that strategy, i.e. we don't look for value, we're sure to make sure that we don't have a sustainable investment strategy. Rule number 3, don't be a concentrated investor. So what is concentrated investing? If you look at the chart on the right here, I think it demonstrates it the most clearly. Please come in. So if you look at the chart here, essentially what it's showing you is the dispersion of returns depending on how many businesses you own within your portfolio. So if we take the two extremes, if we look at the yellow line here, if you have 250 businesses in your portfolio, you can see the dispersion of returns is relatively narrow. And if you compare that to the green line, which is the 10-stock portfolio, you can see the dispersion of returns is much wider. The question here then, so clearly, if you want to outperform the market, you have to have a different set of holdings compared to it. So we would then advocate having a more concentrated portfolio because the dispersion of returns is greater. But just having a greater dispersion of returns doesn't mean anything unless the dispersion of returns is more positive. So how do you do that? Well, we come back to what we were discussing before, which is value investing, where we want to have a concentrated portfolio, and we believe that value investing is the best way to identify exceptional businesses. And what do we mean when we talk about exceptional businesses? Well, we look at the chart on the right here. What this essentially shows you is the lifetime returns, so the returns of all the stocks in the Russell 3000 index in the US, so pretty much all the available listed equities in the US, from 1980 through 2014. So what you might be able to see from the chart is 0 is the return here. So the median and the mean return of all those stocks was actually negative. So what that says is if you picked a random business in the US during that 34-year period, chances are you would have lost money. Sure.
Sorry, just to clarify a bit. In that graph you have price returns for obviously in a positive way, I guess. On the left side of things,
yes.
How can you have negative return of 150%?
So it's slightly complicated, but essentially if the company does another equity issuance at a higher price,
okay,
and it can, therefore the returns that the investor receives can be substantially less than the 100% number.
Could you repeat this?
So if the business goes down in value by 50%,
yes,
and then they do another share price issuance at that price,
yes,
to new investors,
yes,
they're then back at 100%. So then the business falls by another 50%. So you compound down.
Okay.
But the part that we're really interested in is this part of the graph. So you can see there's a significant right skew to the returns here. And what this says is there's a very small number of businesses that account for pretty much all the returns in the stock market. And that's what we're looking for. We're looking for outlier businesses. If you, I guess the way to think about this is if you own 10 businesses in your portfolio, one of them was 100 times return on your money, and the other 9 went to 0, and you owned that portfolio for 10 years, you'd still compound your money at roughly 20% per year, even with 9 of the businesses you chose going to 0. Because what we're looking for is we're looking for outlier exceptional businesses, because this is where all the returns are generated. Don't be a long-term investor. There are 2 sides to this. So one is related to the previous rule that I just went through, which is investment success requires patience. So even if we manage to identify an outlier business, so in this example, I'm going to talk to you about Amazon. So Amazon is clearly an exceptional business over time and has generated enormous returns in the stock market for investors. Amazon was compounding at roughly between 20 and 25% per year on an annualized basis. But even on that basis, what you can see from the chart is, if a business compounds at 20% per year, you still need to own it for 25 years for you to make 100 times your money. So you still need extreme patience when it comes to your investment time horizon. And the second aspect of this is exactly the businesses that you're investing in. As a value investor, what we're looking for is we're looking for businesses where the management also has a very long-term perspective. So here I put a quote from Jeff Bezos, the founder of Amazon, from his 2007 letter to shareholders. And here he's talking about the fact that Amazon has a very long-term focus. He actually concludes by saying, at Amazon, we like things to work in 5 to 7 years. We're willing to plant seeds and to let them grow. and we're very stubborn. We say we are stubborn on the vision and flexible on the details. And then one of the reasons for this is actually at the top here. He says everything you do needs to work on a 3 to 5 year time horizon, because then if it works on a less than 3 year, you're competing against a lot of people. So the further out you expand your investment time horizon, the less people you're competing with. And our final rule is don't be a sustainable investor. So at my fund, we're concentrated long-term value investors. So we believe that the businesses that we invest in are very willing to engage with us because they know that we're long-term orientated. And therefore we're comfortable and competent at working with them regarding their ESG or environmental sustainability and governance strategies, as well as their sustainability principles. So some of our investors or some investors that we might ask, well, why would you want to do that? And we say, well, over time, we believe that the businesses that lead their respective industries in terms of sustainability tend to outperform the market over time. And we believe they do that because they increase the depth and width of the economic moat around their business over time. And that in turn leads not only just to increased returns for me as the shareholder, but also increased returns for society at large. The academic research, which you can see in the chart here on the right, that tends to show essentially the same correlation. So what you can see in the blue line is for any given sector that we look at, the company that has the most ambitious environmental, social, and governance goals tends to outperform its peers, which you can see in the yellow line, over time. What this can lead to is there's two aspects to it. So one is obviously we want to invest in the business that has the best returns, so the one that has the strongest ESG goals. But at the same time, the competitor businesses are going to be looking at the industry leader and thinking, well, how can we narrow this gap? Well, clearly the easiest way is to adopt those ambitious environmental, social, and governance goals so that that gap narrows. But the industry leader wants to keep it as wide as possible. So what you have there is a positive feedback loop, where the industry leader is constantly trying to increase the ambition of their environmental, social, and governance goals, and their competitors are trying to narrow the gap as quickly as possible. There are two other aspects. Oh, absolutely.
Can we go back to the graph?
Sure.
So you're saying that successful businesses usually have ESG goals that are defined and that are quite high compared to others, right? But maybe they are successful on other bases and they have the extra cash or extra capacity to actually invest in those ESG purposes, and that's what making the difference. It's not the ESG that is making the performance. It's that they already perform well and then most on the case for everything.
Yeah, so I think that it's an interesting one because I think what you could say is very successful businesses who have, rightly as you said, excess cash, they almost have the ability to therefore have ambitious environmental, social, and governance goals because they can afford to do it. So what we need to make sure, so the test that the paper that I referenced here, which is called Active Ownership by Dimson and Carapace, actually controls the sample size for exactly that. Because it's very true that what you could easily find is correlation between the most successful business in the industry that has the most cash available and therefore how ambitious their ESG goals are. So you do have to control for that in your tests to make sure they're fair. So I think that's a very, very good question. Within our fund, there are two other aspects. So once you own a portfolio of businesses, you want to engage with them. This is part of our portfolio management. So when we engage with our businesses from a sustainability perspective, we introduce our investment partnership to the management teams. We outline ESG best practices in their sector. And in general, what we do is we provide a 10,000-foot view, as we call it. Because what we find is the management teams of the businesses that we invest in can very often be focused solely on their business and not on the sector or the industry at large. And therefore, we can help them with industry best practices. I mean, we can also explain to them what their peers and what their competitors are doing. And we can also focus on the benefits of having environmental, social, and governance focus within the business in terms of both the societal benefits, but also in terms of financial returns. And from there, we move to a process of continuous monitoring, because we believe that achieving superior investment returns is just as important as how they are achieved. And in general, the result of this is we do an annual written review on the progress of each of our individual holdings during the course of the year as they work towards their ESG goals, which we provide to all of our investors. So if I was to summarize that, our 5 rules as to how not to have a sustainable investment strategy, I would say don't be a values focused or value investor. Don't hold yourself or those around you to the highest possible standards in everything you do. And don't embrace a tried and tested method for investment success. I'd say don't be a concentrated investor. Don't center your investment strategy and philosophy around capturing exponential compounding returns. I'd also say don't be a long-term investor. Don't look to invest in businesses that think long-term, and similarly make sure that your investment process focuses on a short-term investment time horizon as possible. I'd say don't be a sustainable investor. Don't look for businesses that set a high bar when it comes to corporate governance, environmental or social factors in either their investment strategy or in their operations. And most importantly, don't remember the famous words from the naturalist Charles Darwin, who said that it's not the strongest of the species that survives. It's also not the most intelligent that survives. It's the most adaptable to change. Thank you so much for your time. I'm very happy to answer any questions that you might have. So we have a microphone, so I think we'll pass it around. Oh, yeah.
So thank you a lot for the presentation. Great initiative also on your career and everything you've done. So let me ask, if you're now founding a hedge fund, is that because you see some opportunities in the space? And my question is, do you think that having right now a long-only portfolio of concentrated bets can outperform other hedge funds that are more diversified? And why do you think so? And how do you just find your conviction in this kind of strategy with respect to the environment that you normally see with multi-managers, etc.?
So that's cheating, because that's a three-part question. But to take each of them in turn. So we differentiate ourselves at my firm by copying, or what we call cloning, the principles of the original Buffett partnerships from the 1950s. So when Warren Buffett started his hedge funds, he did them very differently from how they're done today. So hedge funds today typically charge a 2% management fee of any assets under management, and a 20% performance fee on any returns generated on those assets. Now, Warren Buffett never charged a management fee because he said, why should I get paid unless I'm already doing a good job for you? So instead, I'll charge a 25% performance fee on any returns I generate above a hurdle rate. And that's essentially what we do. So we differentiate ourselves by the fact that we don't charge a management fee. So when investors invest with us, they know that we only get paid if we're making them money. So that's how we differentiate ourselves from 99.99% of the other 10,000 funds. There's honestly only a handful in the world that charge zero management fee. So that's how we differentiate our business from the rest. So I think that addresses the first part of your question. So, and that's what it says here on this slide. And then when it comes to the second part, we'll be talking about concentration when it comes to investing and whether we think we can outperform over time. I'll go back to these two slides. I certainly do. I think all the research will show you that the more concentrated a portfolio is, the more dispersed the returns. And as I said, there's no point in having dispersed returns unless you're dispersed to the positive skew, which are our outlier businesses that we're looking at here. And I think that the only strategy that's been shown over the last 50 or 60 years that can consistently outperform the market is value investing, where we're trying to identify exceptional businesses and then we have the patience to hold them for the long term. And I think that that's how we will outperform as a hedge fund over time. And I think our returns might have more variability than some other funds, because a fund that goes long and short, you would argue, should have less volatility in terms of the price action. But I would argue that the returns are less likely to outperform the benchmark than a strategy such as ours, because the differential factor is the fact that we're willing to own the business for the long term. And as we looked at when we were talking about compounding of returns, it's only by holding for a long period of time that you can achieve 100 times return on your money. So I'd say those are the differentiation factors and our strategy as well.
So, okay. I'm going to jump back to what you said. So you talked about value investing a lot. I don't like one.
It's so that we could all hit.
Yeah. So you talked about value investing a lot, and actually acquiring businesses or investing in businesses that are fair valued, right? But now we're seeing, during 2024, 2023, that some businesses were overvalued and then they jump back. So how do you find a fair business? And how do you find fair value in that case? What are the key characteristics that you look for when you're looking at an investment?
It's a very good question. Because it's going to sound very trite, the answer. What do we look for in my fund? We're looking for strong growth potential, widening economic moats, and a business that's run by high integrity management who think like we do as business owners. So the question then will be, well, how do we find those things? So there are a variety of different ways. So strong growth potential, arguably, you could screen for that. So if you look at return on capital employed for a business over time, you could screen the universe of equities on that basis, and you'd come up with a short list. So that's one method of doing it. Widening economic moats. Here we're thinking really about margins. What are the gross and operating and net margins of the business? Because typically businesses that have high margins tend to have pricing power. And pricing power is what we mean by an economic moat. So think about the things that you buy. If you have a subscription to Netflix, I think it'd be a good example. So if you've got a Netflix subscription and you get an email, which I actually got just the other day, where they said they're raising the price of the subscription. Did I cancel my Netflix subscription? No, I didn't. I'm going to pay the extra, I think it's €2 or whatever it is per month to continue with my Netflix subscription. So that's a business that clearly has an economic moat around it. Because even though they're increasing the prices of their subscriptions, current users don't leave. And people still want to join with the content that they've got. And the final one here, high integrity management. This is the hardest one, I think, to quantitatively identify. This you really require doing a qualitative analysis of the business. So here we want to look at all the evidence and all the information we can find in the current management team. So this would be newspaper articles, trading industry conferences, any speaker events that they've been to, any previous employers and any track record that they've got, either with a previous employer or a current one, to try and make sure that they're going to be good stewards of our capital. Because essentially when you invest money into a business, what you're doing is you're saying you think the management team there are going to look after your money and earn you a good rate of return on those funds that you give them. So arguably the most important thing to work out is that that they think like you do as a business owner. They're not spending their capital, the money you give them, to pay themselves a high salary or big bonuses. You want them to take that money and be reinvesting it into the business to grow the pie over time, because that's how you make your return as an investor. Thank you. Sure.
Which sectors do you believe are undervalued and might generate opportunity?
Sorry,
Sectors.
Which sectors?
Yeah, currently undervalued.
So I think it's quite a broad question, even though it's quite a short question. So so our fund is split between the developed markets and emerging markets, roughly 50-50 split. And one of the things that we'll all be aware of is the fact that the markets in the US have done incredibly well over the last few years. And they've been driven really by very few stocks. The Magnificent Seven that we all know about have been the main driver of returns. So one could argue that I like to basically take the process of inversion a step further and be contrarian about it. People tell me the US market is expensive, why would you invest there? And I like to think the opposite, because if you dig a little bit deeper, you see that most of the returns just came from 7 stocks. So actually, I believe there are a lot of businesses in the US and in developed markets that still represent very good value. For us, as value investors, though, we like to go where people aren't looking. So, for example, we have roughly 10% of our portfolio in Turkey. So Turkey has been in the headlines a lot recently. It's a very volatile country in terms of the macroeconomic situation around it. And what you see there in the headlines is the media is there, I always say, is designed to sell newspapers or attract eyeballs on the story if you're reading it online. So therefore, all the headlines are usually quite sensationalist. So they talk about people fleeing the country, that it's totally uninvestable. And it's in places like that that value investors, when we're talking about identifying great businesses, in every market there are great businesses. You just have to go there and find them. And Turkey is a great example where all the capital is flowing out of that economy. And therefore, the share prices of all the businesses there are being pushed down very low. But all of the businesses are. But not all the businesses are bad businesses. there are some incredibly good, very well managed, well run businesses in Turkey that are being unfairly priced because of the macroeconomic situation that's going on there. So that's how I discuss it geographically. If you're talking about specific sectors, I find it much harder because for us, we're bottoms up stock pickers. So fundamentally, we're looking at individual businesses rather than from the sector down. But I would say, if you look today, I'd probably say I'm relatively consensus that I think most of the tech sectors are relatively expensive. But again, I think if you dig a little bit deeper, you might find that it's only a small number of businesses that have dragged up that valuation. There might be some smaller businesses in there that are relatively well valued. And then when we talk about sustainability, it's quite an interesting one because a lot of the businesses that are unsustainable, like as a broad general category, their prices have gone down quite a lot. So if you look at coal businesses, listed coal businesses, their share price performance in general has been terrible for the last 5 years because for a lot of investors now, they are classified as uninvestable, i.e. they don't fit within any ESG category. And therefore, a lot of investors can't invest in them. So actually, a lot of those businesses are very cheap. The question is whether you want to take the reverse side of those flows and look at those sorts of businesses. We don't invest in coal businesses in our investment partnership, mainly because for us, even though we can invest in them, they don't tick the long-term ESG criteria boxes. Thank you for your question.
I just wanted to ask, who are your investors and how do you strike a balance between explaining to them a strategy and not losing your edge?
Yeah, I think that's a good question. So from our perspective, or I should say from my perspective, I think there's two ways to run a hedge fund. One is that you are completely open about your investment strategy and you're completely straightforward to your investors, in which case you can explain to them what you're doing and they just appreciate that you are better at it than they would be. The flip side of that is you have an entirely black box method of investing, whereby I invest in a certain way and I don't tell you what I do, but you just trust that I know what I'm doing and therefore you don't ask too many questions. So a lot of very complicated quant strategy or rapid fire hedge funds are black box because there's no single investment thesis, there is no process behind it. It's run by algorithms and the like. Whereas, and that's one end of the spectrum. We're entirely at the other. So I don't think we lose our edge by telling our investors how we do what we do, because we believe that we have the right temperament to be able to do it. But a good example of this is if you look at the returns, let's use the S&P 500 for an example. If you own the S&P 500 for the last 2 years, you would have made 25% per year. How many investors who've invested in the S&P 500 do you actually think made 25% per year for the last 2 years?
Oh, no.
It's because it's absolutely right. It's very close. It won't be zero, but it'll be very few. It'll be less than 10%. And I can tell you that because all the academic studies show on historical samples that investors they don't have the right temperament to invest. They buy high and they sell low. They're constantly locking in the losses. So of course, it's easy to look back and be like, if I had bought and held for 2 years, I'd have made roughly 65% compounded. But actually, would I have been able to hold during something like the recent pullback where the market fell, roughly 12%? Would you have still been holding when the newspapers are talking about there's a recession coming, etc.? So even though you know how to invest, I've just told you how to do it, it doesn't mean that you're able to execute it and earn those returns. So that's why, for us, we don't feel like that we lose our edge when we discuss these things in public forums and tell people what we do. Thank you.
Where are you going?
No, just a quick question. At the beginning of the presentation, you talked about intellectual honesty, and I'm not sure what it means. Can you explain, maybe, what you mean by intellectual honesty?
Sure. So I think we were talking about values. So for us, I think when we talk about ourselves, we don't often describe ourselves as a hedge fund. We often talk about ourselves as an investment partnership. And partnership is the key aspect of that, which means that we treat everybody that we encounter and everybody we work with within our business remit as partners. And by that, I mean that the investors in our business are also our partners. And the companies that we work with are also our partners. And related to that is honesty. And intellectual honesty, I think, is at the core of both our investment philosophy as well as our business philosophy. And to explain that, you have to understand what investing is. We're making a series of concentrated bets in our investment portfolio. And we're not going to be right all of the time. There's actually a quote here that I've left on one of these slides. So this is Peter Lynch's ran the Fidelity Magellan Fund, and he was one of the most successful investors of all time. And what he says here is you can expect to be wrong about 40% of the time. And he's one of the world's most successful investors. So that means if you go in a portfolio of 10 businesses, probably 4 of them you're going to be wrong on, which means they're going to go down in value. So how do you make sure that they don't weigh on your returns, that you don't hold them for too long? That requires intellectual honesty to be able to admit that you're wrong. And there's a humility that comes with that. Because if you're arrogant and you lack the ability to review the investment decision you've made objectively, then you're going to get into a lot of trouble very quickly. Because if the most successful investor can be wrong 40% of the time, then what does that mean for the rest of us? It probably means that we're going to be wrong probably a little bit more than 40% of the time. So that's what intellectual honesty is when it comes to the investment process, which means when we run our investment process on our individual holdings, we do it again every year, at least once, to make sure that all of the answers that we gave ourselves as to why we should invest are still true today. And if they're not, are they not for the wrong reasons? Which means, have they negated the real reason why we invested in the beginning? And that's what we mean by intellectual honesty.
Yeah, thank you for your presentation. And I actually have 2 questions. So the first question is like, can you elaborate more on how you interact with the management teams? And especially that you are a long-term investor. So I imagine sometimes the management team may leave, the CEO may change, and how do you deal with that? And especially what is your approach different from other activist investors such as Alloy, such as Amber Capital? And my second question is like you are focusing on long-term investment. So how do you, in your point of view, how do you view the strategies from other hedge funds such as Citadel, who only cares about what is happening next quarter and doesn't really look at the long run? Thank you.
Thank you. So to address the first of the 2 questions, so the management teams are willing to speak to us because we are long-term investors. And which links a little bit to your second question. Citadel might not care what the business's trajectory is over 3 to 5 years. So Citadel, for those that don't know, is a very large hedge fund. And they're very, I'd say they're probably a lot more short-term focused than we are, and they turn over their portfolio a lot more. So they're more on the black box side of investing than we are. And I don't think Citadel would want to meet the management teams, and I don't think the management teams would want to meet Citadel, because Citadel would only care what is the next quarter's earnings and how can I profit from that. Whereas we look to engage with the management teams. So when I talked about engagement and continuously monitoring, we need to add value to the management team. We need to give them a reason to want to talk to us. And the way that we do that is through the way that we engage with them. By being able to look at all of their competitors and essentially look at where their business is doing really well from an environmental, social, and governance perspective, but also compared to all of their competitors, because no business is perfect. No business does everything correctly. So if we can identify their areas of weakness and present them to them in an appropriate way and say, look, you rank really well on environmental, social, and governance criteria, but within corporate governance, we think that you need to have a stronger executive compensation policy. That would be a way that we would approach it with them. We'd say, look, these are 2 of your competitors and this is how they do it. That's the way that we frame those conversations. Then it becomes a back and forth dialogue. Because what we find is the management teams of the business are focused day to day on just running their business. They're not always aware of what everybody else is doing within their particular sector. And even then, sometimes the best ESG criteria and strategies are found in a different sector. And we can basically, or a different part of the world even, and we can bring that information back to them and show them. So that's the way that we sort of try to foster a dialogue and a relationship with them. And then to address a little bit more the second question, well, I think there's fundamentally, when I talk about there's 2 different ways of discussing your investment strategy, black box and being completely open about it. there's clearly different ways of making your money within the hedge fund space. So when we were talking to the question I was asked right at the very beginning, when we were talking about volatility of returns and whether you can outperform the market, it all links back to whatever strategy you have, which also links back very neatly to essentially the very first slide where we were talking about what does a hedge fund actually look like? Well, the final part, the money is pooled with the manager who invests in a series of securities to achieve a specified rate of return. Well, the investors have to tell the hedge fund manager what they want. So some investors want lower returns with lower volatility. The ideal would be very high returns with very low volatility, but there is not really any long-term proven method of being able to do that. Whereas what we do is our investors are happy to take higher short-term volatility to make higher long-term returns. That's how we differentiate. Thank you.
Okay, so we tend to think as a business owner as those people who have a perfect plan, they went to business and did everything right. But actually, when we talk to them, it's more like they took a leap of faith, use their knowledge, and just figure it out along the way. So I'm just curious about your experience when opening your business, especially as hedge funds are one of the hardest business to actually start.
Yes, so I can give you an example of it. I really like that question. So I can give you an example of a leap of faith. So when we started our hedge fund in 2022, I don't know how many of you will remember then, but 2022 was when we came out of COVID and the market was very, very strong. And 2022 was the year where the S&P fell 30% between January and October. And we launched our fund during that period of time. And we had the money from the management team, myself included. And then we also had some investors to invest alongside us when we launched. And they told us in January, they said, this is going to be perfect. We're ready. We have the money ready for you. When we were ready to launch, sort of 7 months later into the year, the market was down 25%. Interest rates had gone from 0 to 5% during that period of time. And our investors said, we're going to wait and see. So for us as value investors, and also for me and the management team as business owners of our fund, I've told you that we're contrarian, that we're concentrated, and actually, how are we going to outperform the market? We need to be buying cheaply. So when the market falls a lot, that's the perfect opportunity for us because we're looking to buy businesses cheaply. So we actually launched our business with no external investors. We launched it just with our own money. So that's an example for you there of a leap of faith because there was no guarantee that we knew that the market would come back quickly. There was also no guarantee that we knew that the returns would be good enough that the investors would come in. Luckily, sometimes you do need some luck in this business, which is timing. So when we invested in 2022, we ended the following continuous 12-month period, which would take us to October 2023, up almost 20%. So during that period of time, we showed that we could outperform, we could execute on the strategy, and the investors that were originally going to come in, they actually came in and they came in with twice as much money. And they definitely regretted not coming in the beginning. So I appreciate what you said there. I think that, whether it's a CEO of a business or someone like me that started their own business or is working for somebody else, a lot of parts of your career will involve leaps of faith. And they will also involve luck when it comes to timing, because that's the one thing that you have no control over. I have no control over whether the market goes up or down. All I know is that the portfolio we own is exceptional in terms of businesses. So I think over the long term, we're going to compound capital very well. But I need to be able to communicate that, coming back to your question, very clearly with our investors. And they need to understand how I do it. Because only then, when we report a down period, do they go, it's okay, we'll actually give you more money. Because we know you're buying businesses even cheaper today. And you're going to make even more of a return in the future. Thank you for your question. Sure.
Just perhaps, on your background, you did rates before, you did many things. How come you start a long, fundamental, long-going, from your perspective, you've done many asset classes. How come did you decide to be a value investor and probably global macro or another type of investor?
Can I just complete the question? And why not
Yes.
private credit in that case? Because working credit.
And why not private credit? Private, not private credit, because I wasn't smart enough to see how big private credit would become. So that's my intellectual honesty. So one of the things I think you find with investing is when you see the most successful investors, whether it's Ken Griffin at Citadel or whether it's Warren Buffett at Berkshire Hathaway, they are clearly completely different investment strategies, but they're both exceptional at what they do. And I think there are quite a few things that they have in common, even though their strategies are entirely different. So number one would be that they're entirely contrarian. They do not think like other people. They don't have the usual background that you associate with being successful in industry or etc. Ken Griffin started Citadel from his dorm room at Harvard University with a satellite dish trading convertible bonds. That's how Citadel began. So he never went to a big bank and did an internship. So he automatically was completely different from everybody else. And Warren Buffett definitely never worked at any other investment company other than working for Ben Graham, who's basically known as the father of value investing. So I think to be a great investor, if we look at the similarities these people have, they think differently. They are very, very comfortable doing things that other people won't do. They're comfortable being contrarian. And I think that's a key element of your investment strategy. And I think that also can be shown in sort of in your upbringing and in your background, because these guys are also both at core, they're entrepreneurs, because they're running businesses. So for me, I didn't mention it, but it's at the bottom of the slide here. I started and ran several businesses from the age of 7 onwards. I was 7 when I started my first business. It was in the high school playground. We were trading computer games. And since then, I started several more businesses all the way up until my hedge fund. Because one of the things you have to do, obviously, if you want to run your own business, is you have to be an entrepreneur. And in my field, not only do you have to be a good entrepreneur, you also have to be a good investor. You need both things to run a successful hedge fund. Because if you can't sell the business, manage the business, run the business, it doesn't matter what your investment returns are, because you won't have a business anymore. And vice versa. There's no point in being really, really good at running a business if your investment returns are no good. We need to be able to do both. So my background is very varied. It's very different. But I think the fact that I went to I lived in 12 different houses. I went to 8 different schools in 6 different countries when I was growing up. So I'd say that I have a very diverse background. And I think that has led me to be comfortable with being contrarian and comfortable with being an outsider. So I think that that's a core part of who I am. And that's what reads through into our investment strategy. And you're right. I think for me, what I wanted to do is I really wanted to understand the full investment landscape, which is why I went into trading at investment banks to start with. And I started on the macroeconomic side because I thought, well, how can I know what I'm going to be good at if I don't explore everything? So I wanted to explore the macroeconomic side, which was trading interest rates. And then I wanted to explore the microeconomic side, which was trading credit. But one of the interesting things is, or not so interesting things, is if you work at a bank, the one thing you can't do is what with your personal funds is you can't invest or buy whatever it is that you're trading at the bank. So for that reason, the only thing during my 10 years in banking that I could invest in was long-only equities. And that's what I found that I was good at. By the time that I left Credit Suisse, I was making more money from investing in my long-only equities portfolio than I was earning as a credit trader at Credit Suisse. So you could read that 2 ways. Either I was really good at investing in my sole account, or I was a terrible employee not earning very much money. I'd like to hope it was the former. But all of these experiences, and I would say the same for all of you, the most important thing is to try many things. Try many things, because you don't know what you're going to be good at. And then also, in addition to that, you might learn a lot or learn something really important for what you do in later life from a job that seems totally unrelated. There's very little related to what I do today with global macro trading. I think that's a fair thing to say. But at the same time, there were some key aspects of that during that experience that are part of our investment philosophy today. So you're going to round us off with one last, not to put you on the spot.
Thank you so much for your talk. I have 2 questions regarding how you manage your portfolio.
Sure.
So first, you said that your fund is really concentrated. I'm just curious about what do you think is the sweet spot in terms of how many companies you hold at the same time? And then I was also curious that these like famous investors usually say like obviously invest in the long term. but at some point, like there are good businesses and bad businesses, and I hope like we got the bad businesses as early as possible. What changes or what do you look for when you try to like when you give up in specific business? Or what bad experiences have you had with certain stuff?
I think two very good questions. I would say, so to take the second question first, to identify, although I suppose I combine the two. So when we talk about a concentrated portfolio of investments, everybody has their own temperament as an investor. So temperament is how you react when something you don't want to have happens. So for example, if you've got 10,000 euros and you put 1,000 euros into 10 businesses, if one of those, you wake up tomorrow and the first headline is one of those 10 businesses has gone bankrupt, what do? Now, if you sell the other 9 because one of your businesses has gone to zero, that tells you something about your risk appetite and how you act as an investor. Similarly, if the inverse was to happen, that you woke up in the morning and one of your stocks has doubled in value, how do you react to that? Do you automatically sell because you quickly got a double on your money? Or do you look at it a little bit closer and go, actually, I think you're a lot further from here? These all give you insights into how you are, what you're like as an investor, because we all act completely differently. And that's how it links into your second question about concentration. Because depending on what your reaction is to making money and losing money, should tell you a lot about how diversified your individual portfolio should be. I know people that only own 4 stocks in their portfolio, and it doesn't bother them at all that every day when they wake up, they are going to be just the noise of the market, plus or minus 10% in a day. And it doesn't bother them at all. And that's all the majority of their liquid net worth. There are people at the other end of the spectrum that want to own the S&P 500 index because they own 500 stocks and they're like, I'm comfortable with, 2 to 5 or 0 to 5% on average daily volatility. That's acceptable to me. And what you have to work out is what works for you. So for us, we divided our portfolio into developed markets and emerging markets, and we essentially have 10 holdings in each. So we have a 20 stock portfolio. So you would say that most of our investments started at roughly a 5% holding. And then how we differentiate ourselves is we have the humility or the intellectual honesty to say, I don't know which of the 20 stocks will be the best business over the long term. I don't. In any one year, one stock that performs very well one year might be the worst performer the following year. So on that basis, we don't weight our holdings based on what our conviction is about the idea. So they're all the same weighting. And then we let the market tell us whether we're right or wrong. So if the share price goes up over time, clearly our investment thesis was correct, as long as it's increasing over the long term. And that 5% holding, if it doubles, will become 10%. And we don't cut, we allow our winners to run. On the flip side of it, if you think about it, so our upside then is relatively unlimited, right? Because a business that you buy for $1 could go to $1,000 or $1 million over time. So we've got asymmetry to the upside. And then if you look at it the other way, what's our risk? Our risk is that we've got one position in our portfolio that's 5% of the overall capital in our fund, and then it goes down in value. Now, as value investors, we're going to make sure that we're investing in businesses that we think are quite conservative, and therefore we're buying them for less than we think that they're going to be worth. So therefore, it should be very, very unlikely that that business ever goes to zero. So that would be the first thing. And that would be our worst outcome, that we have a permanent loss of capital, the value of business goes to zero. And then in terms of how quickly do you cut the position that's going against you? Well, this is where you have to disassociate yourself with the share price. So for example, for me, I don't look, it's not when a piece of information comes out about a business, I don't look at the share price. I read the headline, I read the article, and then I think in my head, what should this do to the share price? And what often you find is what happens to the share price is the opposite to what you think should happen. Because the current share price is the value of everybody in the market owns that stock, what they think about it. So you have to try and always be a contrarian when it comes to price action. So to answer that second part of your question, if the share price falls, but the fundamentals of the business remain the same, we don't cover the door. It's only if the underlying business fundamentals, i.e., is it growing less than we thought it was, Has it got more competition than we thought it did? Like fundamentally affecting the business to the downside. That's when we cut the position very quickly. Very welcome. Okay, well, just say thank you everybody for your time. I really enjoyed this session. And what was your name, sorry, in the call? Ali. Ali, I'm going to give you a copy of the book because I really enjoyed that. But thank you very much.
Certainly, that's great. Thank you so much.
Thank you.
Very good.